Day 22. Let's start with the rise of electronic trading 3.3. When first established, Nasdaq was primarily an over-the-counter dealer market, and the NYSE was a specialist market. But today, both are primarily electronic markets. These changes were driven by an interaction of the new technologies and new regulations. New regulations allowed brokers to compete for business, broke the hold that dealers once had on information about the best available bid and ask prices, forced integration of markets, and allowed securities to trade in ever smaller price increments called tick sizes. Technology made it possible for traders to rapidly compare prices across markets and direct their trades to the markets with the best prices. The resulting competition drove down the cost of trading execution to a tiny fraction of its level just a few decades ago. In 1975, fixed commissions on NYSE were eliminated, which freed brokers to compete for business by lowering their fees. In that year, also, Congress amended the Securities Exchange Act to create the national market system to at least partially centralize trading across exchanges and enhance competition among different market makers. The idea was to implement a centralized reporting of transactions as well as a centralized price quotation system to give traders a broader view of trading opportunities across markets. The aftermath of the 1994 scandal at Nasdaq turned out to be a major impetus in the further evolution and integration of markets. Nasdaq dealers were found to be colluding to maintain wide bid ask spreads. For example, if a stock was listed at $30 bid, 30.5 ask, a retail client who wished to buy shares from the dealer would pay $30.50, while a client who wished to sell shares would only receive $30. Um, the dealer would pocket the half point spread as profit. Other traders may have been willing to step in with better prices. Example, there may have been willing to buy shares for $30 and 1 by 8 dollars, or sell them for 33 by $8. But those better quotes were not made available to the public, enabling dealers to profit from artificially wide spreads at the public's expense. When these practices came to light, an antitrust lawsuit was brought against Nasdaq. In response to the scandal, the SEC instituted new order handling rules. Published dealer quotes now had to reflect limit orders of customers, allowing them to effectively compete with dealers to capture trades. As part of the antitrust settlement, Nasdaq agreed to integrate quotes from the ECN's electronic what was it communication networks into its public display, enabling the electronic exchanges to also compete for the trades. Shortly after the settlement, the SEC adopted Regulation ATS, Alternative Trading Systems, giving ECNs the right to register as stock exchanges. Not surprisingly, they captured an ever larger market share, and in the wake of this new competition, bid ask spreads narrowed. Even more dramatic narrowing of trading costs came in 1997 when the SEC allowed the minimum tick size to fall from 1/8 of a dollar to 1/16. Not long after, in 2001, the decimalization allowed the tick size to fall to 1 cent. Bid ask spreads fell again dramatically. Figure 3.5 shows estimates of the effective spread, the cost of a transaction, during three distinct time periods defined by the minimum tick size. Notice how dramatically effective spread falls along with the minimum tick size. Technology was also changing trading price practices. The first ECN, Instinet, was established in 1969. By the 1990s, exchanges around the world were rapidly adopting full electronic trading systems. Europe led the way in this evolution, but eventually American exchanges followed suit. The National Association of Securities Dealers, NASD, spun off the Nasdaq stock market as a separate entity in 2000, which quickly evolved into a centralized limit order matching system, effectively a large ECN. The NYSE acquired the Electronic Archipelago Exchange in 2006 and renamed it NYSE Arca. In 2005, the SEC adopted regulation NMS for National Market System, which was fully implemented in 2007. The goal was to link exchanges electronically, thereby creating, in effect, one integrated electronic market. The regulation required exchanges to honor the quotes of other exchanges when they could be executed automatically. An exchange that could not handle a quote electronically would be labeled a slow market under Reg NMS, uh, National Market System, and could be ignored by other market participants. The NYSE, which was still devoted to the specialist system, was particularly at risk of being passed over, and in response to this pressure, it moved aggressively toward automated execution of trades, electronic trading networks, and the integration of markets in the wake of Reg NMS made it much easier for exchanges around the world to compete. The NYSE lost its effective monopoly in the trading of its own listed stocks, and by the end of the decade, its share in the trading of NYSE listed stocks fell from about 75% to 25%. While specialists still exist, trading today is overwhelmingly electronic, at least for stocks. Bonds are still traded in more traditional dealer markets. In the US, the share of electronic trading in equities rose from about 16% in the year 2000 to over 80% by the end of the decade. In the rest of the world, the dominance of electronic trading is even greater. Now we go on to 3.4 US markets. Also, by the way, we can see the bid-ask spread decreasing. So there was the 8th regime, then there was the 16th, and there's the decimal regime. So as people are getting more transparent information across the market, and what all other dealers and what all the dealers are charging as their bid-ask spread, as that had to be made more transparent, so people can't lie anymore and say that this is actually the bid-ask spread when it really isn't. So they had to reduce to the decimal regime. So that's what we were talking about there. Now it's 3.4, the US markets. So the NYSE and the Nasdaq stock market must remain the best known US stock markets, but electronic communication networks have steadily increased their market share. Figure 3.6 shows the comparative trading volume of the NYSE listed shares on the NYSE and Nasdaq, as well as the major ECNs, namely BATS, NYSE Arca, and Direct Edge. Since this study was published, BATS and Direct Edge merged, creating one of the largest stock exchanges called the BATS Global Markets. The other category, in which exceeds the 30%, includes so-called dark pools, which we will discuss shortly. So that sounds interesting. So as we can see, the figure 3.6 market share of trading in NYSE listed shares has gone. I don't know which one is which. Yeah, okay. So the NYSE has gone down from about 80% in which year is this? Okay, from 80% in February 2002 to about 27% in Feb 2011. So that's almost a 60% fall. And we can see for the others, it's increased, and pretty much everybody else has increased in volume. So what I'm assuming is that the percentage of market share that was lost in NYSE has been distributed in the others, because that's how it would work. It's a zero-sum game. So NYSE lost its market share, while all these other Nasdaq, OMX, NYSE Arca, BATS, other Direct Edge, they gained in value, in market share. So now we'll talk about Nasdaq. So the Nasdaq stock market lists around 3,000 firms. It has steadily introduced ever more sophisticated trading platforms, which today handle the great majority of its trades. Its Nasdaq Market Center consolidates Nasdaq's previous electronic markets into one integrated system. Nasdaq merged in 2007 with OMX, a Swedish-Finnish company that controls 7 Nordic and Baltic stock exchanges to form Nasdaq OMX Group. In addition to maintaining the Nasdaq stock market, it also maintains several stock markets in Europe as well as an options and futures exchange in the US. Nasdaq has 3 levels of subscribers. The highest, level 3 subscribers, are registered market makers. These are firms that make a market in securities, maintaining inventories of securities and post bid and ask prices at which they are willing to buy or sell shares. Level 3 subscribers can enter and change bid ask quotes continually and have the fastest execution of trades. They profit from the spread between bid and ask prices. Level 2 subscribers receive all bid and ask quotes but cannot enter their own quotes. They can see what market makers are offering as the best prices. These subscribers tend to be brokerage firms that execute trades for clients, don't actively deal in stocks for their own account. Level 1 subscriber receive only inside quotes, the best bid and ask prices, but they don't see how many shares are being offered. These subscribers tend to be investors who are not actively buying or selling but want information on current prices. The New York Stock Exchange, the NYSE, IC, is IC by the market value of listed stocks. Daily trading volume on the NYSE is about 1 billion shares. That's a lot. In 2006, the NYSE merged with Archipelago Exchange to form a publicly held company called the NYSE Group, and then in 2007 merged with the European exchange Euronext to form NYSE Euronext. The firm acquired American Stock Exchange in 2008, which was renamed NYSE Amex and focuses on smaller firms. NYSE Arca is the firm's electronic communication network, and this is where the bulk of the exchange traded funds trade. In 2013, NYSE Euronext was purchased by international exchange ICE. ICE has retained the NYSE Euronext name. The NYSE was long committed to its specialist trading system, which relied heavily on human participation in trade execution. It began its transition to electronic trading for smaller trades in 1976, which the introduction of its DOT, designated order turnaround, and later super DOT systems, which could route orders directly to the specialist. In the year 2000, the exchange launched Direct Plus, which could automatically cross smaller trades up to 1,099 shares without human intervention. And in 2004, it began eliminating the size restrictions on Direct Plus trades. The change of emphasis directly accelerated in 2006 with the introduction of the NYSE hybrid market, which allowed brokers to send orders either for immediate electronic execution or to the specialist who could seek price improvement from another trader. The hybrid system allowed the NYSE to qualify as a fast market for the purposes of regulation NMS, but still offer the advantages of human intervention for more complicated trades. In contrast, NYSE's ARCA marketplace is fully electronic. So, ECNs. Over time, more fully automated markets have gained market share at the expense of less automated ones, in particular the NYSE. Brokers have an affiliation with an ECN, have computer access, and can enter orders in the limit order book. As orders are received, the system determines whether there is a matching order, and if so, the trade is immediately crossed. Originally, ECNs were open only to other traders using the same system, but following the implementation of Reg NMS, ECNs began listing limit orders on other networks. Traders could use their computer systems to sift through the limit orders books of many ECNs and instantaneously route orders to the market with the best prices. Those cross-market links have become the impetus for one of the more popular strategies of so-called high-frequency traders, which seek to profit from an even small transitory discrepancy in prices across markets. Speed is obviously of the essence here, and ECNs compete in terms of speed they can offer. Latency refers to the time it takes to accept, process, and deliver a trading order. So this is pretty important. Time it takes to accept, process, and deliver a trading order. For example, BATS, one of the biggest ECNs, advertises latency times of around 200 microseconds, i.e. 0.002 second. It's pretty fast. Okay, 3.5 new trading strategies. Actually, I'll just read this part first. the flash crash of May 2010, and I'll end it at that for today. Then I'll go have dinner. So yeah, the flash crash of May 2010 at 2:52 New York time on May 6th, 2010, the Dow Jones Industrial Average was already down about 300 points for the day. The market was demonstrating concerns about the European debt crisis, and nerves were already on edge. Then, in the next 5 minutes, the Dow dropped an additional 600 points, and only 20 minutes after that, it recovered most of those 600 points. Besides the staggering intraday volatility of the broad market, trading in individual shares and ETFs was even more disrupted. The iShares Russell 1000 Value Fund temporarily fell from $59 a share to 8 cents. Shares in the large consulting company Accenture, which had just sold for $38, traded at 1 cent only a minute or two later. At the other extreme, price quotes for Apple and Hewlett Packard momently increased to over $100,000. These markets were clearly broken. The causes of the flash crash are still debated. An SEC report issued after the trade pointed to a $4 billion sale of market index futures contract by a mutual fund. As market prices began to tumble, many algorithmic trading programs withdrew from the markets, and that those that remained became net sellers, further pushing down equity prices. As more and more of these algorithmic traders shut down, liquidity in these markets evaporated, buyers for stocks simply disappeared. Finally, trading was halted for a short period. When it resumed, buyers had to take advantage of many severely depressed stock prices, and the market rebounded almost as quickly as it had crashed. Given the intraday turbulence and clearly distorted prices at which some trades had been executed, the NYSE and Nasdaq decided to cancel all the trades that were executed more than 60% away from a reference price close to the opening price of the day. Almost 70% of the cancelled trades involved ETFs. The SEC has since approved experimentation with new circuit breakers to halt trading for 5 minutes in large stocks that rise or fall by more than 10% in a 5-minute period. The idea is to prevent trading algorithms from moving share prices quickly before human traders have a chance to determine whether those prices are moving in response to fundamental information. The flash crash highlighted the fragility of markets in face of the huge variation in trading volume created by algorithmic traders. The potential for these high frequency traders to withdraw from markets in periods of turbulence remains a concern, and many observers are not convinced that we are protected from future flash crashes. So that was pretty interesting. Tomorrow we will continue with new trading strategies 3.5. Thank you.